Thank you, Karna. Hello, everyone. Thank you for joining us today to discuss LTI's financial results for the third quarter of fiscal 2018. The financial statements, press release, and quarterly fact sheets are available in our filings with the stock exchanges and at the investors section of our website. On the call, we have Mr. Sanjay Jalona, CEO and Managing Director, and the leadership team. Sanjay and Ashok will give you a brief overview of the company's performance, which will be followed by a Q&A session. As a policy, we do not provide specific revenue or earnings guidance, and anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. Let me now invite Sanjay to talk about the results. Over to you, Sanjay.
Thank you, Nitin. Hello, everyone, and wish you all a very happy new year. We had an outstanding quarter with US dollar revenues of $293.5 million, up 8.5% quarter-on-quarter and 19.7% on a year-on-year basis. Digital revenues now make up to a third of our overall revenue base. To give you some color on this 8.5% growth, this includes the benefit of 0.7 contribution from Syncordis, 2.2% from pass-through from India, and a very strong 5.6% quarter-on-quarter growth coming from the core business. We are pleased with how the quarter panned out, and I would like to highlight that our Q3 numbers are a result of our focused approach to deliver amplified outcomes to our clients. A few words on Syncordis acquisition. This quarter is also special because we announced that we successfully closed Syncordis, our second acquisition in the last 18 months. Syncordis brings end-to-end Temenos capabilities and an exclusive focus on T24 Temenos Digital Suite. Q3 results continue to demonstrate our broad-based nature of growth. You can see growth performance across verticals, service offerings, and geographies. Our relentless focus on digital, analytics, automation, IoT, and cloud technologies is helping us differentiate in the marketplace. We added 17 new clients this quarter, 4 of them being Fortune 500 companies. These 4 companies are also from 4 different verticals, mirroring the broad-based nature of our quarterly financial performance. The 4 verticals are insurance, manufacturing, CPG, and pharma, where we open 1 Fortune 500 customer each. The traction in new age technologies that is reflected in our financial performance is also validated by industry experts. We had multiple wins and recognition this quarter, and the 2 key wins that I would like to highlight to you are: 1, LTI being positioned as a leader for digital focus in Nielsen Hall's NEAT report for digital testing, and HFS featuring us in high performers in the Blueprint report for enterprise blockchain services. Let me now give you some color on the industry-specific numbers and trends. In terms of performance by verticals, highlights are: in BFS, we delivered 7.9% quarter-on-quarter growth in BFS. Overall, we continue to feel optimistic about this vertical. Our digital book of work led by data continues to grow at a very fast pace here. With acquisition of Syncordis, core banking solution, we have another weapon in our arsenal to sustain growth momentum in this vertical. This also helps us do very new dialogues in Europe region. Insurance vertical grew 2.1% quarter-on-quarter for us. We are witnessing pressure on run the business spend, but clients are spending money on digital technologies. Our expertise on new age technologies and deep domain knowledge helped us win a Fortune 500 insurance logo in Q3. The client selected LTI for our expertise in understanding the business processes of an insurance company. We would be mapping and analyzing all of client front and back office processes and use RPA to deliver operational efficiencies. In manufacturing, the highest pass-through revenue for Q3 has lifted the performances of this vertical, registering a 16.6% quarter-on-quarter growth. The base business, excluding the impact of pass-through, also grew sequentially. There are 2 key trends that we are witnessing here. First, cloud-enabled IT modernization has become mainstream, and we see more and more clients embarking on programs to move majority workloads to cloud. And secondly, we have selectively also seen ERP modernization, especially in SAP and Oracle economies, starting to come on the radar. In energy and utilities, we had a steady sequential growth of 6.3%. There is an improvement in this sector, and as you know, all prices have also stabilized. Even so, clients are also planning to continue with a lean operating model, as they believe operating at a lower break-even point is overall healthy for the future. In Q3, LTI was selected by a client to be a digital consultant for rationalizing all of its application portfolio and creating artificial intelligence-based chatbots, etc. for their user support. CPG retail and pharma, Q3 marked second consecutive quarter of double-digit sequential growth at 10.8%. You would recall that we had called out CPG retail and pharma to drive growth for us in FY18, and the results are there for you to see. Two of the Fortune 500 logos that were added in this quarter fall under this vertical. We are driving growth in this segment by bringing innovative client solutions using digital technology. For example, one of the Fortune 500 companies that we opened, LTI was chosen as a strategic partner where we will be using our tools and Accelerate to automate and migrate their financial analytics reporting. In high-tech and media, after a strong Q2, we saw this vertical deliver 4.3% quarter-on-quarter growth in Q3. We are very pleased with the progress that we are making with some of the leading global tech logos that we opened in this vertical last year. In the other segment, which includes clients present in the areas of defense, travel, logistics, and services, some of our India-based projects are classified under this vertical, and we experience some quarterly ups and downs based on the project milestones. As a result, we have seen a sharp rebound in Q3 in this vertical after a tepid Q2. In terms of service lines, Enterprise Solutions had another fantastic quarter of strong growth of 18.9% quarter-on-quarter. Revenue contribution from Syncordis and pass-through contribution appear here in our service line mix as well. Our new age technology service line continue to do well in this. Analytics, AI, and cognitive service lines reported 7.3% quarter-on-quarter. Enterprise integration and mobility service line grew 5.9% quarter-on-quarter. As we had articulated on our last earnings call, we have seen a healthy 7.9% quarter-on-quarter growth in IMS space as some of the large deals announced earlier ramped up. Before I hand over to Ashok to talk about Q3 financials, let me share with you some broader thoughts on our future outlook. I have always maintained that we would be either in the leadership quadrant or the industry leader in revenue growth. Last year we delivered 10% constant currency revenue growth. We expect to deliver mid-teens growth at FY18 given that 3 quarters are over, and we will sequentially grow in Q4 as well. 2 large deals that we have announced with last quarter results would start to fuel growth in Q2 and Q3 in FY19. We also have a strong deal pipeline, and closure of these deals would further fuel in FY19 with a special focus for the organization on H2 of FY19 currently. With that, let me hand it over to Ashok to give you the financial details.
Thank you, Sanjay. Hello everyone, this is Ashok here. Wish you all a very, very happy new year. We are starting 2018 on a very, very strong note. It was indeed a good and busy quarter with solid top-line growth, M&A activities, and our annual analyst meet in December. So with that, let me start and again go through the headline numbers first. Our revenue in Q3 grew at 8.5% sequentially and 19.7% on YOY basis, and we're at $293.5 million. This corresponds to constant currency growth of 8.3% and 16.4% respectively. Reported revenue in INR terms was 18,837 million. Accelerating YOY growth over the last 6 quarters reflects good growth momentum which we have been able to achieve on our revenue front. On profitability, our operating profit margin stood at 14.9%, improving by 40 basis points versus 14.5% in quarter 2. Better realized rates and volume growth helped absorb the headwinds due to lower working days in this quarter. Our quarter 3 profit after tax were 2,828 million rupees, up 3.6% on quarter-on-quarter basis and up 14% on YOY basis. PAT margin for quarter 3 stood at 15% as against 15.6% in quarter 2. Other income comprising of mutual fund investment income and FX gains was lower this quarter compared to quarter 2 by INR 136 million, leading to 60 basis point drop in PAT margin. We expect going forward our PAT margin to remain in a similar band from current levels. Talking about some of the employee metrics, our utilization stood at 80.3% including trainees and 81.5% without trainees, up by 73 basis point and 82 basis point respectively quarter-on-quarter. We continue to add resources at every level and net addition for quarter 3 stood at 840 employees. Attrition for the quarter was also down by 40 basis point at 14.6% on LTM basis compared to quarter 2. Now, looking at our forex and hedge book, we continue to maintain and improve our hedging strategy, and it has been serving us well during appreciation of Indian rupee over the last 3 quarters and has kept our PAT margin in good health. Cash flow hedges as at 31st December 2017 stood at $1 million, and on balance sheet hedges stood at $102 million. Effective tax rate was 23.4% for quarter 3 as against 23.2% for quarter 2. Some of our HEV units are moving out of 100% bucket to 50% bucket in the coming years, and we expect tax rates to slightly inch up, but for FY18, FY19, 23 to 25% is going to be the band where we should be operating. EPS for the quarter was 16 rupees 49 per share, while diluted EPS stood at rupees 16.16. On DSO front, we had a good comeback. DSO for quarter 2 stood at 69 days as against 76 days in the previous quarter, which had a very good impact on cash flows. With improved working capital situation, operating cash flow stood at 22.1% of total revenue for the quarter, and it saw at 147% conversion of profit after tax. Cash and liquid investment as at 31st December stood at INR 15,031 million. Syncordis acquisition was completed, as Sanjay mentioned in his speech, and has strengthened our position in GFS market of Europe. We have used cutoff date of 1st December 2017, so for 1 month we consolidated Syncordis in our books, and which has contributed 1.9 million from Syncordis to this quarter. With that, I think we will open the floor for
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Urmil Shah from IDBI Capital. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats on a strong quarter. So my first question is on the manufacturing segment. So after 2 quarters of softness, in this quarter it has seen good growth even after we removed the pass-through revenue. So wanted your commentary on the same. How should we look at it going forward?
Look, manufacturing is a very differentiated sector for us, and because of our heritage, because of the capabilities, because of the weightage that we have over the years on this sector, and with the digitization efforts that are going on the world over, there is a tremendous opportunity in front of us to digitize a cement factory, digitize an elevator factory, digitize an manufacturing diversified conglomerate. And we are also seeing good amount of discussion starting to happen in ERP transformation, especially led on S/4HANA and cloud products of Oracle and Salesforce and others. Obviously we had a one-off because of the project pass-through in the India project there, but I think we will continue. We feel positive about that as a differentiated vertical, and you will continue to see growth for us.
Sure. So my second question was on the top 5 accounts. While top 6 to top 20 have taken care of like slightly slower growth, anything to bother within the top 5 accounts?
Nothing at all. Sometimes when you look at quarter on quarter, it can get a little deceptive. But let me give you one data point. In the last 9 months, if you look at it, the top 5 accounts have also grown by 15%. And same as the company's growth.
Sure. Thanks, and all the best.
And we are positive on the 5 accounts, just to be confirmed.
Got that. Thanks.
Thank you. In order to ensure that the management is able to address questions from all the participants in the queue, we request the participants to limit their questions up to 2. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Sandeep Agarwal from Edelweiss Securities. Please go ahead.
Hi, Sanjay. Congrats on a very good set of numbers.
Excuse me, this is the operator. Mr. Agarwal, can you speak please closer to the phone, please?
Yeah, hi. Thanks for taking my question and congrats to the management team for such a good numbers.
Thank you, Sandeep.
Yeah, Sanjay, just wanted to understand when we stand now versus last year, are you seeing that most of the clients have started opening up their wallets to spend more on the IT, primarily driven by the newer technologies, where you need to be more agile in terms of how fast you can transmit data into information and all social media and other things. And also, are you seeing any kind of deals which are for capacity expansion to handle the massive amount of data which is flowing in?
2 questions, break it into 2 parts. So on the first part, where are we compared to last year? Look, Sandeep, you would remember, since the time we went public and started talking to you, we have always said that we don't see the market being very, very difficult. If you have a story to tell, if you have the capabilities to take to the customers in the newer realms of tectonic shifts because of digital, there is business to be had. And that has reflected over the years in terms of the businesses and the growth that you have seen in the large deals, etc., that we have closed. But where we sit today, the world over, the economies are definitely doing well. If you look at US itself, this year US would grow very, at 3% or thereabouts, and that's quite phenomenal. And that automatically gives a lot of confidence to the customers in terms of their spends. But you also got to remember, every company is very different. So when I look at only our company, we don't have a lot of overhangs, right? We don't have an BPO overhang being commoditized. We don't have old infrastructure businesses. We have adopted and accepted the all things digital, including dog fooding within, which has helped us differentiate and take it forward. So we always felt positive, and in times to come, yes, the world over, the economies are doing well, companies are a lot more confident, so we are only seeing increased conversations with them. On your second part, I think analytics is very big. Analytics is everywhere. When you do digital transformation, analytics comes in more ways than none, including in IoT. In my view, IoT, one is retrofitting products or fitting sensors, but it's at the end of it, it's data and what you do with data. Our large program last year, CBDT, is one of the largest programs, but in all across, with our initiative, which we call ADR, ADEA, Analytics and Digital in Every Account, we have seen incredible growth in analytics, and conversations are really stretched. So out of the 4 accounts, at least 2 accounts I know which actually got opened on really analytics, right? Really differentiated analytics, which help customers enter new markets, which help them launch new models of engagement with the consumers. So yeah, analytics is very big. By the way, we grew last year 35% in analytics area, and this year also we are looking at a very strong growth.
Thanks, Sanjay. Thanks a lot, and best of luck for the future quarters.
Thank you, my friend.
Thank you. The next question is from the line of Abhishek Bhandari from Macquarie. Please go ahead.
Yeah, good morning to the management team and congratulations.
Thank you, Abhishek. We like your report from last night.
Thank you so much. I just had 2 questions. First is, since we met 45 days ago, when you had said that you are in, contention for $800 million to $1 billion worth of pipeline, and there's some probability, of course, on that number. How much, progress has been done since that time in terms of, the deal actually materializing for us?
I want to just clarify and set records straight. This is a pipeline of deals that we see, which are incremental deals. Large, small, existing accounts, new pipeline, large deals, everything in there, which is at which is something which we are attacking overall. It's not the large deals alone that we talked about in the first analyst day that we had in December of 16. But yeah, the kind of conversations that we are doing with customers, the way we are getting invited to large deals, the initiatives like Minecraft and area that we are taking to the customers, the capabilities that we are investing in, Mosaic Security, a new service offering that we launched in Q2. All of these things are helping us, do well. As I said in my opening remarks, our focus is on, the deals that we have announced will really ramp up and fuel the growth in Q2, Q3. And our focus is right now in converting and focusing on these $800 odd million in H2 of FY19.
Sure, that's helpful. And my second question actually has 2 subparts, but both are related to the US taxation. First, does BEAT in any way impact us? And 2, do you think all this tax reform, what US has unleashed in terms of lowering the corporate tax rate, will actually help in some of your clients, your own portfolio clients, to spend more?
Abhishek, I will take that question, Ashok here. While there are, of course, many important changes the tax reform has brought in, 2 of the changes which are of most importance to us or IT industry in general, Indian IT industry. One is, of course, federal tax rate reduction, 35% to 21%, benefits everyone, corporate US as well as companies and branches operating in US. And this change is effective 1st January. Then it has some beneficial impact on us also. The BEAT part, which is right now is still being evaluated and not very clear, so difficult to comment, but it has raised certain concerns definitely, and we are still evaluating. What we believe, branch status, we operate through a branch structure in US, may have a little bit favorable outcome when the whole riddle is solved, but still many parts which are not well understood on BEAT, and very difficult to comment anything, whether it will have a neutral impact or negative impact. As far as the whole US Inc. is concerned, there is certainly going to be they are going to be benefited and have more money at their disposal. But to my mind, straightway thinking 35 to 21 would be hyping it up too much, because effective tax rate of US Inc., which was paying on an average, was still 23-24%. So, but yes, the confidence has increased, as Sanjay also spoke about it. There are not still clarity on a state tax side, so state tax will start playing major role, and those announcements are also not out. So we will gradually know that all the reforms which have been announced at federal level, whether the states are also going to adopt that. So still wait and watch, Abhishek. I think it will take 2-3 months to my mind to fully understand the impact of US tax.
Thank you and wish you a very good year ahead.
Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from India Infoline. Please go ahead.
Yeah, thanks. Man, congratulations on a great quarter.
Thank you, Rishi.
Of course, Happy New Year. A couple of questions, one, Sanjay, on verticals. So one is financial services, where, some of your larger peers have talked about, next year looking better compared to the previous one. So how you are looking at from your client's perspective? Of course, for you, financial services anyways done well, but are you seeing, broad-based optimism around financial services? And secondly, on insurance side, since you are pretty heavy on the PNC, any sense on, what could be the pressure on the industry because of a pretty, bad last year for the insurers?
Right.
That impacts, our clients, or large part of that is getting reinsured, and hence our clients would not be impacted. So, color in both of them will be helpful.
See, on BFS, obviously, as you rightly said, Rishi, we did well on BFS so far in the last 6-7 quarters. And we continue to feel confident on BFS. Obviously, we have another tool in our arsenal with Syncordis, where we would have different dialogues, especially in Europe. Obviously, we announced another large deal in South Africa, which will again also drive up the incremental growth. So overall, we continue to be positive, and BFS will continue to look good. On insurance, you said it right. I think calendar year 2017 saw lots of huge losses the world over for all the insurance companies. But the way it works for insurance companies, effectively is, yes, they have losses, and then they will raise the premiums and so on and so forth. So lots of us are not looking forward, especially those who live in US, to see the premiums going up. But, the journey on digitization on insurance will continue to be there. We have a significantly differentiated offering with capabilities like accuracy, ICON, etc., that we have created ourselves in insurance. And on top of that, the differentiation with the leading products like Guidewire, Duck Creek, Insurity, etc., keeps us in good stead when we go into discussions with our customers, because they are using these platforms as agents of change in their digital journey. So yes, wait and watch, wait and watch in insurance, but where we are with the dialogues we are having, we feel good, but we will see where it goes.
Okay, and second one on margins. So, we have, our hiring has gone up by about 15% year on year, and clearly we have improved our utilization rates as well. We have some large deals coming up for ramp up. So just wanted to get some sense in terms of, how do we look at, margins from a 12 to 18 month perspective, considering, of course, there will be transition costs related to large deals, and we have already done a lot of hiring with utilizations now pretty much at an all-time high level.
So, Rishi, you rightly mentioned that transitioning new large deals, ramping up, still requires some investment support from us. And if you would have, heard Sanjay and us, that we feel pretty comfortable and confident about maintaining our margin at this point of time and going forward for a couple of more quarters in the similar range, and whatever extra resources which we are able to get from either our improving of the pyramid or looking at some of the rate realization improvement initiatives and SG&A optimization, though sales and marketing remains an invest area, but G&A we are optimizing in a big way. So all these things we are pumping back to the business, because still a lot of investments are needed, whether it is Mosaic, whether new launch service security, whether creating facilities for future growth, because we need to create facilities and they don't get used immediately. So we keep on getting some of the P&L hits because of that. So I I feel more comfortable at this point of time to say that our PAT margin would remain in similar band for next 2 to 3 quarters view at least I can think about.
Focus very clearly, Rishi, is on driving growth, keeping the margins and investing in the business, whether it's platforms, whether it's the transitions, etc. that we are doing, localization that we are doing, and a number of initiatives, but continue to differentiate in the marketplace.
Great. Thank you and best of luck.
Thank you, Rishi.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity and wish you a very happy new year and congratulations on a great quarter.
Thank you.
So Sanjay, the first question was actually on, just wanted to get a sense, so if you look at your build efforts, around 23-24% of the efforts is in on-site and being pretty range-bound amidst a very healthy growth in digital, which is now 1/3 of your overall business. So I just wanted to get a sense, will it be possible to share a ballpark on how would this on-site effort compare in particularly the digital segment versus the non-digital? Would it be significantly different or any trend over there that would be of greater offshore while the deal sizes get larger?
See, I want to take half a minute, not directly answering your question, but I will directly answer your question as well, Ashish. Just to talk a little bit about digital, right? People confuse often digital with just some technology stack. But what digital is, as we articulated in our analyst day, it's a way of working. And if you look at what we call as LTI digital, way of working. And it's got 5 things built in it. The first thing is you need to have cutting edge capabilities and full tech stack, ability to do things in the newer technologies that are coming up, mushrooming every single day. Second thing is next generation delivery models, right? How do you move away from the old waterfall model, etc., to agile DevOps kind of model. Third is extreme domain focus. What will you digitize unless you know the business processes in and out very, very well. Fourth thing is, everyone talks about platform, but really what is key is the ability to provide business outcomes to the customer. And the last one is you need to be digital inside yourself before you can preach to somebody on how digital they need to be. And all of these 5 things, help customers do either next generation operations, transformed experiences, enabling new revenue growth engines, or enabling new business models altogether. Now, when you look at this, there is no legacy anymore. Right? People are looking at doing businesses using all of these technologies, all of these new ways of working, all of these, business outcome related things on top of platforms that are existing or coming up every day to provide value. And, while there are portions when you do things a little bit more on-site, but overall at a level, I think it's so broad-based that you can actually keep executing at the same on-site offshore ratios. So that's why I gave you a long answer, just to explain why I believe that it can actually be done at the same on-site offshore ratio.
Right. No, that's helpful. And just secondly from my side was on the enterprise solutions. So since the segment has been particularly very, very strong, if you could just elaborate on or just break it out into what solutions are particularly driving this traction, and how would you look at the sustainable growth within this segment? If you think the current rate of momentum can be sustained going forward as well?
Yeah. So look, one, you got to keep in mind that the India pass-through also had some licenses built in as a part of a program, large program that we're doing. In addition to that, when you look at new businesses, I think SAP, the cloud, the S/4HANA, etc., there is a tremendous opportunity that is there in the marketplace, and it is only going to increase in times to come. Oracle Cloud is doing well. SuccessFactors, clouds, lots of areas, cloud apps, lots of areas where there are tremendous opportunities as they become more and more mainstream, everyone trying to do more and more things with them. And given where we are, we have invested very heavily. We talked about it 2 years back, and we continue to invest in there. We will also see, as banks do a lot of transformation, you will also see Syncordis helping us in this area with the whole T24 digital suite from Temenos being implemented with the banks.
Got it. Thanks. That's it from my side, and all the best for the year ahead.
Thank you.
Thank you. The next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Thanks for taking my question, and congrats on a great quarter.
Thank you, Apurva.
So my first question, with very strong acceleration clearly and the validation of strategy, growth moving from 10% to now mid-teens. Looking at the demand environment with the wins that you talked about and the ramp-up schedule, how would you qualitatively look at FY19? Would it be fair to say a similar growth momentum is sustainable?
Look, Apurva, we don't give guidance, but I'll give you enough flavor. I think, obviously if you do the numbers, you can easily figure that out. Last year we did 10% constant currency. This year, obviously sitting where we are, you already know 3 quarters number, and I've already said that we will have incremental growth ex Syncordis also. So obviously Syncordis full quarter revenues will come, so we will definitely be in mid-teens. With the large deals that we have announced, which will start ramping up from Q2, Q3 onwards, we are quite optimistic and focusing all our energies right now on H2 of FY19. So yes, we do feel excited and excited about FY19 now.
Sure, and just a follow-up to that, if you can highlight the verticals which is expected to lead growth in that.
Apurva, actually, if you look at it, we have, the entire company is built on focus. So what we do is just keep focusing on few verticals, few customers, few service lines that we have built and expertise on, and we just keep driving growth. Obviously, high-tech and media and entertainment will continue to grow. CPG, pharma, retail will continue to grow. BFS will definitely grow. Manufacturing will grow. Actually, everything will grow, but you can take it in that order.
Got it. Thanks for that, Sanjay. Just a quick bookkeeping one. If you can give a split of the other comprehensive income for the quarter.
I'll request Ashok to give that.
Okay, so it's largely the MTM which has gone to the hedging reserve instead of P&L. If I remember the number correctly, it was close to 594 million rupees. That's the major element. Then there is a foreign currency translation reserve, which is a small amount, less than 10 million rupees, and that's the 2 broad head of our other comprehensive income. Okay?
Got it. Thank you and all the best.
Thank you. The next question is from the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, thanks for the opportunity. Happy New Year and congrats on a very strong execution.
Thanks.
Yeah. Just on the large deals, you said in this quarter means Q3 we have closed the large deals.
Q2 we announced 2 large deals.
Okay. So, Sanjay, now as our scale, I think we are scaling up one of the best in the industry on the mid-size players. So, to continue this momentum on the scale up, do you believe internally you have set a target in terms of winning large deals each quarter and how we can do that?
Oh, absolutely we have target, but I am telling you that. Right? There is a definite focus on, look, how do IT companies grow? They grow on top of large deals, they grow on top of large accounts, and they grow on top of opening logos that drive up the growth in 12 months, 18 months down the line, right? Meaningful growth. And we will focus on all of them. We will focus on new age infrastructure deals, we will focus on new age digital deals, we will focus on large analytics programs, large ERP programs, and so on and so forth. So yes, there is a focus, there is a target, there are incentives for people to do large deals, there are incentives for people to break the mold of normal growth that we do on a yearly basis and do exponential growth within their portfolios, yes, we reward people for performance.
Okay. So on a YOY in the market, on the ground, you believe there are enough such deals and we can continue the momentum going forward? Because what we hear from some of the large peers are there are n number of small size deals because of which your feet on the ground has to be much intensive. But do you also believe the large size deals are enough on the ground?
Look, I think you're asking me a relative question. And, with my 30 years working in this industry, obviously things have changed over the years. But, where we sit today, Sandeep, I think there is enough for us to actually keep posting meaningful growth in the market on a consistent basis. I don't see, we have enough participation. Obviously, you need to go with a very sound solution. You need to go with a value proposition and not only a running, but a solution, but also a transformation solution to the customer. And that, if we can meaningfully do, your conversion rate goes up. So where we sit, I think there is enough for us to digest.
Okay. And how should we correlate your 800 million pipeline with $1 billion pipeline, which we had at the end of CY 2016? So is it the definition has changed? Or is it we should not read too much into this?
Don't read too much into it. It is something which is incremental, right? And actually, the way to I should, maybe we never tell this, but I will say it anyway. A lot of pipeline is actually at the proposal stage.
Okay. That's helpful. Just last two things, Ashok, from the finance side. What do we, in the cash flow statement, there is a line item shown as credit support agreement with a positive amount. So is it an increase in the debt?
So what happens, we have this FX hedging lines with various institutions. And some of the institutions, we have this credit support agreement, where when the MTMs goes up and down, just to secure the credit, the actual flow of fund happens. But when that fund comes to us, because the FX hedges are in gain, that's a kind of liability for me. I have to, if the market moves, I will have to return back it also. So but it's not really debt. The monies do come to me, which I effectively use for my operating purposes or investment. So it's not in the nature of debt, but these are the agreements which we have some of the financial institutions. Just to secure that when we are in deep money, we receive some money from these institutions as well.
Okay. So this is like a realized forex gain for you?
I would not say realized, because this is still at MTM level.
Okay. Just second question on your hedge strategy. What I understand is generally we take a call in terms of the premium to the spot rate. And now if rupee appreciates, which we have seen, that premium may fall. So this may lead to some change in your hedging strategy going forward?
I don't think we are going to change hedging strategy. And I think the consistency is a very, very core ingredient of any strategy with respect to hedging. So if rupee appreciate, assuming though we really don't share that view very strongly, but because our hedging strategy is not view based, rather a lot of things are done on the basis of rule. Even if rupee appreciates, of course my hedge gains goes up. But as I move forward and spot keep on appreciating, gradually the average hedge rate will come down for me. But my hedge book, which I am holding currently, I gave you the number about 800 million plus 100 million, about roughly 900 million, gives me enough long rope for next 5 to 6 quarters to kind of navigate entire volatility on either side of the rupee movement.
Okay. Thank you. All the best. This is very helpful.
Thank you.
Thank you. In order to ensure that the management is able to address questions from the participants in the queue, we request the participants to limit their questions up to one. If you have a follow-up question, we request you to please rejoin the queue. The next question is from the line of Ramesh Mantri from White Oak Capital. Please go ahead.
Yeah. Good morning to Team LTI. Congratulations on a great execution. My question is on the opportunity you see in Temenos implementations. can you just, we have seen very strong commentary from Temenos, particularly on Europe BFSI. Can you just talk of Temenos' competitive positioning versus competing platforms, and particularly the opportunity in North America? Are you seeing a trend change in North America on banking transformations?
Sure. I will request my colleague Aftab to address that. Hi, this is Aftab. So we're seeing, first of all, from a Temenos standpoint, clearly T24 is positioned in the leaders quadrant by all the analysts with regards to its ability to help banks transform. We're seeing three sets of things happening at the same time. One, slightly smaller banks going big bang. I think that's an incredible opportunity, mostly in Europe, but also in some other geographies. The second thing we're seeing very interestingly is banks opening up essentially a digital brand, letting that scale up and then migrating their core bank onto the new digital bank. And the third thing we're seeing is the traditional SI type work where banks go and rip core banking systems apart. This is, as you might expect, not that common, although it's still happening. We believe that Temenos is a great story and credentials across all three. Slightly hot, or relatively from a geography standpoint, hot in Europe relative to other places, but I'm sure it'll pick up there as well.
And are you seeing similar activity? Do you have outlook on North America BFSI on a pickup in transformations, digital transformation for large banks also?
So they have been in the journey of digital transformation, Ramesh, for a while. But Temenos is more in European and Asia Pacific and other geographies. Temenos does not have a strong presence in North American geography. So, Temenos focuses in Europe, in Asia Pacific. This is a new capability for us, so we'll continue to mine Europe. There is a great opportunity. They grew double digit last year. They will grow. We are confident they'll go double digit this calendar year as well. There is enough and good pipeline there. The kind of conversations that we are engaged in is very exciting. We are also investing and going to invest even more in enhancing the capabilities so we can enlarge the footprint of Syncordis in the geography even more.
And question is, will you be...
This is the operator, so maybe request you to please rejoin the queue for follow-ups. Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hey, congrats, Sanjay, on a great quarter. Just two questions. Firstly, have you seen any change in the conversion cycle or the decision-making cycle for the large deals compared to a few months back or a few quarters back?
Okay, I think broadly everyone is actually trying to expedite and crunch down the time on the deals compared to what used to take some 2 years, 1.5 years, and so on and so forth. So we're seeing the large deals. First, they are smaller in size because of the nature of new technology and what you can do with them. Secondly, the crunch time, as people have understood how to do these deals from sourcing point of view, they are trying to do it in a very crunched manner.
Sure. And secondly, just wanted to understand that with the changes in technology, the service offerings have to be transformed, and every company is in the process of that. Is it a fair way to look at that the transformation in the form of digital as percentage of revenues, or there are other ways to look at each of the service offerings, how much it is transformed and how much it is still aligned to the older technologies and legacy ones?
No, I think, look, customers will only give you business on what is available and what's bringing the maximum on top, either driving efficiency or helping them launch new products in the marketplace or expediting new revenue growth channels and so on and so forth. And, the core of our service offerings and enhancements is an integral part of the journey that we started 3 years back. LTI always had very, very strong IP, strong capabilities in the areas that we operate in. For example, if you look at our SAP profiler is next to none. It's really top class, right? Our entire Mosaic thing, we have beaten the best and the brightest from large companies, global SIs, when we go to the market. So enhancing the capabilities on each and every service line has been a key journey point for us in the last 3 years specifically, because if you don't have the base capabilities, you cannot talk about what is most important for customers. That is to provide amplified outcomes to them, right? So that's what we have focused on as an organization.
Okay. Thanks a lot, and all the best for the future.
Thank you. The next question is from the line of Shashi Bhushan from Axis Capital. Please go ahead.
Yeah, thanks for taking my question, sir, and congrats on very good quarter.
Thank you, Shashi.
In terms of the way this quarter played out for you, were you positively surprised by the growth, and what led this positive surprise? Is it like few large deal ramp-ups, or was it more broad-based, stuff?
Shashi, thanks for your wishes, and you should just read, what I say. I have said we are, won the deals, and I have, even when we talked in the last quarter and the analyst day, I said H2 will be better. So you should have definitely known that we are well set for these. The way these have happened is obviously the ramp-ups on the deals that we closed, 4 quarters, 5 quarters back that we had announced earlier. Obviously continuing to focus on large accounts and opening new logos.
So, and just last one from me, did we see similar built-up in our pipeline also, the way a deal ramp-up has happened?
Yeah, pipeline, the quality of conversations that we are having with the customers continue to be strong. We have, as we talked about, a good pipeline, qualified pipeline, good conversations happening. And with the deals announced last quarter in Q2, which will start to ramp up in Q2 and Q3 of FY19. Our focus is really on H2 of FY19 to help some of the deals that we have currently to push them through and drive up the entire FY19 growth.
Thanks a lot, sir, and all the best for the next year.
Thank you, Shashi.
Thank you. The next question is from the line of Dipesh Mehta from SBI Cap Securities. Please go ahead.
Yes, sir. Just one question about the pass-through revenue, whether it has any implication on our reported margins?
Pass-through revenue,
Yeah. Of course, compared to
what
service
was
revenue,
the adjusted margin? Just want to understand, and what are the plus and minuses during the quarter for adjusted margin?
So I will give you some broad, numbers to give you flavor. Pass-through had about 60 basis point impact, adverse impact on our margin, and which got compensated with the improved utilization, which gave us about 30 basis points. We could do better SG&A management, which also gave us 90 basis points. Of course, currency was also adverse this quarter, 30 basis points. And then I have mentioned in my opening remark that lower number of working days, etc., were got offset by rate realization. So that's the construct. So pass-through, to answer your question specifically, pass-through does have a negative impact of 60 basis points in this quarter.
Sure. Thank you, sir.
Thank you. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Hey, hi. Thanks for taking my question, and very happy New Year. Sanjay, just wanted your thoughts on, the broader market, because I understand we have a very far improved sales rhythm, and the deal wins are, quite decent in terms of ensuring revenues for the first half and so forth, and we chase the second half of next year. But are you seeing a broader market uplift in a broader market perspective that should actually drive some positivity incrementally over and above the sales rhythm that you already have?
I think I answered this question, but I'll try to summarize this. Yes, we actually never felt that the market was back, right? And we have continued to say that all the time. I think it is important to have conversations, and the right conversations have helped us in the last many quarters. But you're absolutely right. The performance, the global economy, if you really look at it, and the growth, the way they are growing, including US being, probably will do 3% growth, that gives a lot of confidence to enterprises to do businesses effectively. Enterprises are reporting good numbers, they are growing well. So where we stand today, I think the point is, opportunities are always there in this new world, and they continue to, chug along well. So that's the way I look at it.
Sure. And just one last one from my side.
So maybe request you to please join the queue. We have other participants waiting in the queue.
Sure, go ahead. Yeah.
Thank you. The next question is from the line of Rahul Jain from MK Global. Please go ahead.
Yeah, hi. Just, in terms of if you could break up this high growth that we are expecting in terms of what is the client budget growth, what is the new win contribution, and what is the scope growth or wallet share win if you have to break this up into these three classification, and is it coming at the cost of Indian peers as well?
Rahul, it's a combination of all of this, and you compete in a world which is fiercely competitive. It's all about the value that you bring on to the customers, and that's what we are doing.
Okay, and on Syncordis, we are seeing a lot of...
Excuse me, this is the operator, so may we request you to please join the queue for
Sure.
follow-up questions. Thank you. The next question is from the line of Ankit Pandey from Quant Capital. Please go ahead.
Hi, thanks for taking my question and congratulations on a great quarter. So just my question is around the large deals. Is an execution lag of 4 quarters along expected lines as far as decision-making speed is concerned, and particularly with the view that this is in Europe, of course. May we expect a change in the decision-making speed if things were in the US? And a follow-up or a kind of a light question is with our ENU deals that we won in Q1, the large deals there, and our progress there. That's it.
Okay, I'm now totally lost in the 3 questions you had, but I'll try to answer, Ankit. I think the first question was on large deals and what does it take, how long do they take to really ramp up. I think it's, for the large deals, because one, the transition happens over waves and phases. It sometimes takes anywhere from 1.5 to 2.5 quarters for it to totally ramp up in the support kind of environment, run the business. But the programs and the discretionary works sometimes take a little longer for it to ramp up. So yes, it's quite normal. Nothing has changed the world over. It's quite normal for you to actually see the full benefit of the deals coming up in 3 to 4 quarters time. The second question you asked, something about how long are the deals taking to close, and I lost the question whether it's US.
In the US, particularly with the changes, do you expect business decisions being made quicker?
I do expect the business decisions, and that is a fact that we are seeing because the deal sizes are a lot smaller than they used to be. We are seeing rapid decision making compared to what it used to take a few years back.
Yeah, okay, thanks a lot. And anything on ENU large deals that we had in Q1? That's it, my side.
I think we are ramping up well. We are seeing some of the numbers being reflected there. Despite ups and downs that we have seen in this sector, we have done all right.
All right. Thanks a lot and all the best.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand over the floor back to the management for their closing comments. Over to you, sir.
So folks, thank you very much for your support. Thank you for being at our Analyst Day. We continue to be excited. We see enough opportunities in the marketplace. Look forward to speaking to you in next quarter. Take care. God bless.
Thank you very much, sir. Ladies and gentlemen, on behalf of L&T Infotech, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.